In just 36 hours, more than $7 trillion vanished from the precious metals market. The scale of this move is difficult to comprehend without context, because events of this magnitude do not occur in normal market conditions. Silver collapsed by nearly 30%, breaking below the $85 level and erasing close to $2 trillion in market value. Gold declined more than 13%, slipping under 4,900 and wiping out approximately $5 trillion. Platinum fell over 27%, while palladium dropped more than 21%. This was not a routine correction. This was a historic shock. Technically, this event has been labeled by many as the red candle of death, a pattern associated with violent breakdowns and cascading liquidations. Silver recorded its worst single trading day since 1921. That is more than a century of market history. Yet despite the dramatic headlines and widespread panic, the vast majority of investors are missing what actually matters. Most see this collapse as evidence of weakness. In reality, the underlying dynamics suggest the opposite. What unfolded was not a market failing from fragility, but a system reacting defensively under extreme pressure. When markets are healthy, price declines occur gradually and align with weakening fundamentals. This was different. The speed, size, and coordination of this move point toward deliberate action rather than organic selling. The violence of the decline itself is evidence of strain, not strength, within the system managing price discovery. The scale of intervention required to force prices down this aggressively suggests desperation, not confidence. To understand why, it is essential to look beyond price and into the mechanics of the physical market. The most revealing data point occurred before the crash, not after it. On the first notice day for February silver contracts, delivery notices totaled approximately 9.4 million ounces. Nearly 1,900 contracts stood for delivery. This surge in physical demand occurred before the 20% price smash that followed. The timing matters. Demand was accelerating into the decline, not responding to it. This detail alone challenges the dominant narrative. In weak markets, delivery demand fades as participants avoid taking physical exposure. Here, the opposite occurred. Major institutions issued and stopped hundreds of delivery notices within the same window, rapidly shifting positions and reallocating metal. These were not small adjustments. They were large, urgent movements, consistent with institutions scrambling to manage physical obligations in an environment where supply is tightening. While this activity was unfolding behind the scenes, the paper price was crushed. The disconnect between price action and physical behavior could not be more extreme. To put the magnitude of the broader wipeout into perspective, the $7 trillion erased from precious metals alone would already rank among the largest wealth destruction events in history. When combined with simultaneous losses in U.S. equity markets, total destruction exceeded $10 trillion in under 48 hours. That figure is larger than the annual economic output of nearly every country on Earth, excluding only the two largest economies. It surpasses multiple times the GDP of major developed nations. This was not a sector-specific event. It was a systemic shock that rippled across asset classes. Yet even within this chaos, silver displayed a contradiction that should not be ignored. During intraday trading, silver fell as much as 35%, marking the largest intraday drawdown ever recorded. Despite that, prices still closed the month higher, ending up roughly 19% for the period. This means silver has now posted gains for 9 consecutive months. A market that is supposedly broken does not behave this way. Another critical data point comes from the international physical market. Spot silver prices in Shanghai remained near $122, while futures markets closed near $85. This created a premium of roughly $37 per ounce, translating to more than 43%. Even after a 30% crash, the premium did not compress. It did not disappear. It remained elevated. In functioning markets, severe price declines usually collapse premiums as physical sellers rush to exit positions. That did not happen here. Instead, physical silver in China continued trading at a substantial premium, signaling sustained demand and tight availability. This divergence between paper and physical pricing reveals a fracture in price discovery. At this point, it is important to recognize that not all participants experience this event the same way. Long-term physical holders view price differently from short-term traders. Those focused on accumulating physical metal over months and years are largely unfazed by short-term volatility. For them, lower paper prices combined with elevated physical premiums confirm that fundamentals remain intact. the widening gap between paper and physical markets reinforces their conviction. Short-term traders, however, face a very different reality. A 30% move in 36 hours is catastrophic for leveraged positions. Margin calls do not care about long-term theses. Stops are triggered, positions are liquidated, and accounts are wiped out. This environment punishes overexposure and rewards discipline. Understanding which category you fall into is not optional. It is essential for survival. Both perspectives can coexist, but confusion between them is costly. Long-term accumulation and short-term trading require entirely different risk management frameworks. Treating one like the other leads to mistakes, especially during periods of extreme volatility. When the pieces are assembled, the story becomes clearer. Silver's worst day in more than a century erased nearly $2 trillion in market value. The consensus interpretation frames this as a technical breakdown and the end of a bull market. But that interpretation collapses under scrutiny when physical data is considered. Delivery demand surged before the crash. Physical premiums remained elevated after it. Inventories continued to drain. If fundamentals were deteriorating, these signals would not exist. Physical buyers would retreat, not persist. Premiums would compress, not hold. Instead, the physical market behaved as though supply constraints were intensifying. This leads to a critical conclusion. The crash was not driven by a sudden collapse in demand or an influx of supply. It was driven by aggressive selling in paper futures markets. No new physical metal entered the system. Nothing changed in mine output, industrial consumption, or long-term investment behavior within hours. What changed was the paper price. Silver supply remains structurally tight. Mining output grows slowly, while industrial demand continues to expand across energy, electronics, and transportation sectors. Above-ground inventories are drawn down to meet this demand. Central banks continue to accumulate gold. Investment demand for physical bars and coins remains resilient. These are not conditions consistent with a collapsing market. When price collapses without corresponding changes in supply or demand, the only explanation is forced intervention. Regulators and market structures have repeatedly demonstrated an inability or unwillingness to restrain dominant institutions. The physical market was tightening, delivery demand was rising, and premiums were widening. The system was approaching a squeeze. Faced with that reality, the response was to reset the paper price violently and shake out weak hands. The timing reinforces this interpretation. Massive delivery notices were issued before the crash. Then came the most severe decline in over a century. Afterward, physical premiums remained elevated. Physical buyers did not flee. They continued accumulating. Only the paper market absorbed the damage. Adding to the complexity is a looming macroeconomic catalyst that markets appear to be underestimating. Probabilities indicate a high likelihood of a U.S. government shutdown by the end of January. Historical precedent shows that shutdowns inflict measurable economic damage, delay payments, disrupt contracts, and inject uncertainty into the system. Markets rarely price this risk accurately in advance. The immediate reaction to shutdowns typically follows a predictable sequence. Bonds move first, equities follow. Crypto experiences exaggerated volatility. Precious metals are often sold initially as participants scramble for liquidity. Only later do safe haven flows return as monetary easing expectations rise. What we are witnessing now aligns with the early phase of that cycle. Panic, liquidation, and forced selling dominate. But history also shows that these phases lay the groundwork for powerful reversals. The contradiction remains striking. Silver suffered the largest intraday drawdown ever recorded, yet still ended the month higher and extended a 9-month winning streak. This does not eliminate risk. A crash of this magnitude inflicts real technical damage. Leveraged traders have already been wiped out. Additional selling is possible if liquidity stress intensifies. Paper markets can remain irrational longer than most participants can remain solvent. That reality cannot be ignored. However, none of this invalidates the bullish case for physical metal. The divergence between paper price and physical demand is historically rare. Elevated premiums during a crash signal structural imbalance, not weakness. Physical buyers paying 40 to 50% above futures prices are not expressing fear. They are expressing urgency. The conclusion is not that risk has disappeared, but that the narrative has been distorted. This event was not a spontaneous collapse driven by failing fundamentals. It was a forced repricing designed to relieve pressure in a system under strain. 3 core takeaways emerge. First, silver experienced its worst day in over a century, erasing nearly $2 trillion. Yet delivery demand surged before the crash. That divergence is the central signal. Second, physical premiums remained elevated after a 30% decline, defying normal market behavior and exposing the disconnect between paper and physical pricing. Third, macroeconomic risk from a potential government shutdown adds volatility in the short term, but historically accelerates safe haven demand once initial liquidation passes. The unresolved question is not whether the paper market can push prices lower in the short run. It is whether physical reality will ultimately reassert itself. The evidence suggests that the system reacted out of necessity, not strength. When forced intervention becomes this visible, it is a sign of stress. Extreme volatility punishes leverage and rewards preparation. Understanding the difference between paper price movements and physical market signals is no longer optional. This crash was not about changing fundamentals. It was about desperation within the structure that governs pricing. Logic, discipline, and awareness matter more now than at any point in recent history,